the Bank of Canada made a significant announcement on April 23, 2025. They decided to keep the interest rate unchanged at 5.25%. This decision has sparked much debate and analysis. Some people are relieved, while others are disappointed. Understanding the reasons behind this decision is crucial. It impacts everyone from homeowners to investors. The primary role of the Bank of Canada is to maintain a stable economy. They do this by controlling inflation and promoting economic growth. The interest rate is one of their main tools for achieving these goals. By raising the interest rate, the Bank of Canada can slow down borrowing and spending. Lowering interest rates can stimulate the economy. This recent decision to hold the interest rate suggests a cautious approach. The Bank of Canada is likely trying to balance the risks of inflation with the need for economic growth. They are carefully monitoring economic indicators like inflation, employment, and consumer spending. The coming months will be crucial in determining whether this rate hold is sustainable. The Bank of Canada will continue to monitor the economy closely. They will adjust their approach as needed to maintain stability. The effects of this decision will be felt throughout the Canadian economy. The decision to hold the interest rate at 5.25% brings relief to certain groups. Savers are among the immediate beneficiaries. With interest rates remaining high, they can anticipate earning more on their savings accounts and guaranteed investment certificates. This provides a much-needed boost for those looking to grow their nest eggs. Variable rate mortgage holders are also breathing a sigh of relief. A rate hike would have meant a larger portion of their payments going towards interest. This pause provides a welcome reprieve from the consecutive increases they have faced in recent times. Businesses also stand to gain from this period of stable interest rates. The predictability allows them to plan investments more effectively. It gives them the confidence to pursue expansion plans without the fear of sudden interest rate shocks. This stability is essential for businesses to thrive and contribute to economic growth. Overall, the rate hold provides a much-needed breather for these groups. It offers some stability in uncertain economic times. However, the long-term impacts of this decision remain to be seen. It's important to remember that the Bank of Canada could adjust rates in the future based on economic conditions. While the rate hold offers advantages to some, it presents challenges for others. Prospective homebuyers are among the most affected. The dream of owning a home remains elusive for many, as high interest rates translate to larger mortgage payments. This could further dampen the already cooling housing market. The broader economy also faces headwinds. While stable interest rates can promote investment, the current high rates can also act as a drag on economic growth. Businesses may hesitate to borrow and invest as much as they would with lower rates. This could lead to slower job creation and reduced consumer spending. The fight against inflation also faces a potential setback. While inflation has shown signs of easing, it remains above the Bank of Canada's target range. Holding interest rates steady could potentially reignite inflationary pressures, especially if energy and food prices continue to rise. The rate hold, while offering some stability, also presents a complex economic puzzle. The Bank of Canada will need to carefully analyze incoming data and adjust its approach as needed. The challenge lies in finding the right balance between supporting economic growth and keeping inflation in check. The Bank of Canada's decision to hold interest rates underscores the uncertainty in the current economic climate. The future path of interest rates remains a topic of much speculation. Several factors will influence the Bank of Canada's next move. Inflation will be a key determinant. If inflation persists above the target range, the Bank of Canada may be compelled to raise interest rates again. However, if inflation continues its downward trend and falls within the desired range, the Bank of Canada could maintain the current rates or even consider a rate cut. Economic growth will also play a significant role. Strong economic growth, characterized by robust job creation and consumer spending, could give the Bank of Canada more leeway to keep rates steady or even lower them. However, if the economy weakens, the Bank of Canada may be hesitant to raise rates further, as it could stifle growth. The Bank of Canada faces a delicate balancing act. They must weigh the risks of inflation against the need to support economic growth. The coming months will be crucial in determining the future direction of interest rates. The Bank of Canada will continue to closely monitor economic indicators such as inflation, employment, and GDP growth. The decisions will be guided by data and their mandate to maintain a stable and prosperous Canadian economy.